Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. In previous videos we have discussed strategy and how it is a necessity in Forex. Today we are going to give you a basic strategy that you can practically apply from the knowledge that we have currently accumulated in this channel. In truth, it's possible to make up multiple strategies from what we have currently discussed, but we will focus today mainly on a simple intraday technical based strategy with fundamental awareness and news avoidance being the only fundamental aspect. First, as we are trading intraday and looking to open or close our trades before the end of the day, we're going to quickly refer to the economic calendar to note if there is any medium to high volatility news and which currencies will be affected by this. Remember, we are avoiding news in this strategy, and that is the only fundamental indicator we are including. Upon discovering that there is nothing of significance to interfere with our day trading, we can move on to the next phase. Secondly, we are going to open our charts and observe any currency falling into the major pair category. The reason for this is we want a decent amount of liquidity moving the markets. Let's now look at the Euro USD for example. Looking to the daily chart, we can observe and establish that this pair appears to be in a downtrend, and that is the next step within our strategy: identify the overall trend. Thirdly, we are going to apply some exponential moving averages to our chart. In this instance, we will include the 200 moving averages and the 50 moving averages. So here we have a slow and more respected moving average combined with a faster, less respected moving average. We need to pay attention to where they are in relation to each other, as this market is in a downtrend. We are looking for sell opportunities because we are trending with the flow of the market, and we want the 200 moving average to be above the 50 moving average. If they should cross, this can represent indecision in the market, and we would not be looking for short opportunities. Step 4. We are now going to move down to the 4-hour time frame and begin drawing in support and resistance areas. Anywhere we can see that the market is generally respecting in this downtrend, we are going to highlight like so. As well as drawing in the support and resistance levels, we can also include channels, such as we see in this downtrend. So what we have here is an overall channel downtrending with support and resistance, and some of the key levels that have been respected during general market movement. If you zoom back out to the daily time frame, you should notice that some of your support and resistance levels have been historically respected, and perhaps the reason why the markets react to them. Step 5. This is a key component of our strategy and what we will be basing a lot of our buy and sell decisions upon. We are now going to apply pivot points to the chart and observe market conditions surrounding the pivot and the support and resistance levels they display. Remember, we are selling this market as the trend is our friend and it's currently falling. Step 6. With our pivot points in place, we are now going to observe the candlestick behavior surrounding the pivot point and the support and resistance levels provided by them. Again, we are not looking for buy opportunities, even if we feel that they are clearly presented. The only time that we would be using a buy opportunity in this instant is to exit our sell positions. Here we see that a range has developed in the market. We can see that we have a resistance level which is also being respected by a pivot point in this case. Market prices continually repelled from this point, showing a series of candlesticks that indicate reversal from this point. A longer term trader may even use this strategy to enter during this period, but as we are trading intraday, we are looking for a more short term signal. Eventually, price breaks below the pivot level and establishes beyond it. We are then shown that the retracement occurs to the pivot level and some bearish candlesticks form. I may now consider this a signal for entry to short the market. Based on the highest price that this candle achieved, I would then decide to place my stop loss just beyond it. As we know that good risk to reward ratios are key to success, we would measure the distance from entry to stop loss and then times that by 2 to place our take profit level. This gives us a risk reward ratio of 1 to 2. Meaning that we can lose at least 50% of our trades and still be profitable. If you think about what we essentially did here, we traded a breakout. The same methods would apply if we were trading a reversal from support or resistance. As we can see, this trade went on to conclude in profit, and had we held it, we would have profited further, perhaps deciding to close the trade at the support level depending on candlestick behavior surrounding that level. So let's sum up the checklist. 1. Check the economic calendar so that we may avoid volatile news. 2. Identify the overall trend. In our example's case, it was a downtrend. 3. Apply exponential moving averages. We are ensuring that the 50 EMA is below the 200 EMA. 4. Draw in support and resistance areas or zones. This is great if it aligns with our pivot points and gives us another tick. 5. Apply the pivot points, analyze them for opportunity. 6. Observe the candlestick behavior surrounding the key areas of support and resistance and sell the market when opportunity presents itself. Our opportunity came in the form of a breakout. 7. Use good risk to reward ratios and always pre-calculate the total risk percentage of your trade account. This part is self-explanatory and we have gone over this point countless times. If we can achieve a 2% gain for each 1% risk, for example, even a weekly gain of 2% is something to aspire to. This is a very simple strategy when used correctly with a strong base of knowledge surrounding each component within it. If you are missing parts of information, go back through the videos concerning these subjects to fortify this strategy. You can take this and add additional confirmations, but the main takeaway is we want all of these confirmations pointing in the same direction. The more clues or signals we have identifying a buy or sell, the more likely we will receive the desired result. Please take what you have learned here today and apply it to historical data, noting where you would have succeeded or failed in your trades. If you succeeded, did you stick to the plan? If you failed, why did you fail? Contemplating what you have learned and how you have applied it will increase your confidence and abilities as a trader. Always remember, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.